Welcome back to XRP Insider Network. This is the channel where real crypto intelligence lives. If you want the smartest XRP updates, institutional money tracking, and regulatory truth before it hits mainstream media, make sure you smash that like button, subscribe to the channel, and turn on notifications right now, because what I'm about to show you today is moving fast. Now, listen closely. Bank of America, BlackRock, Vanguard, three pillars of the traditional financial system just made quiet but powerful moves in crypto, and XRP is suddenly sitting right in the blast radius. This isn't hype, this isn't hopium, and this is definitely not coincidence. Something structural is happening behind the scenes, and most retail investors won't understand it until it's already too late. So let me break this down clearly, calmly, and without the noise. Because once you see how these institutions are positioning themselves, this is a structural argument about how global finance actually works when scaled to quadrillions of dollars. Here's the thing most people get wrong about XRP. They think it's supposed to behave like a stock or a meme coin. They think price discovery happens through retail buying and selling. That assumption alone breaks the entire analysis. XRP was never designed as a speculative retail asset. It was designed as a settlement instrument, a liquidity rail, a neutral bridge asset, and that distinction changes everything. Gold doesn't trade based on retail sentiment. Oil doesn't move because someone on Twitter is bullish. Systemically important assets don't rely on vibes, they rely on balance sheets. That's where Dr. Willie's argument starts. He suggests XRP could be treated more like digital gold than a speculative token, not something you trade, but something you post as collateral. And when something becomes collateral, price behaves very differently. Collateral assets must be stable, they must be predictable, they must be capable of supporting leverage across derivatives, lending, clearing, and settlement. Now, think about derivatives for a moment. The global derivatives market isn't trillions. It's not hundreds of trillions. Depending on how you calculate notional exposure, it's well into the quadrillions. Quadrillions. That system cannot run on assets priced at $2, $10, or even $100. The math doesn't allow it. If XRP is used as collateral for even a fraction of that market, the unit price must be extremely high, or the system breaks under collateral requirements. This is where the $12,000 XRP number comes from, not hype, not dreams, math. Institutions don't want billions of tokens moving around constantly. They want minimal friction, high value per unit, low velocity. That's how collateral systems remain stable. Now let's talk about regulation, because this is where things get very real. The Genius Act isn't just some random piece of legislation. It's part of a global alignment around digital asset classification. Once an asset is clearly defined as a commodity instead of a security, institutions can hold it on balance sheets without legal ambiguity. They can use it in settlement, they can tokenize against it, they can build derivatives on top of it. This is why regulatory clarity matters more than price action. You don't assign trillion-dollar settlement roles to assets that could be litigated out of existence. And here's the key insight most people miss. If XRP becomes a recognized digital commodity, similar to gold, its price no longer reflects retail supply and demand. It reflects how much value the system needs it to carry. Gold doesn't need to be cheap, it needs to be sufficient. Now ask yourself this: if XRP is used to settle tokenized bonds, tokenized real estate, tokenized equities, cross border trade, interbank settlements, does a $50 XRP make sense? Or does a very high fixed price suddenly become logical? Dr. Willie argues that once the system locks in XRP's role, free market volatility becomes a liability, and liabilities are eliminated in system design. Fixed price, controlled liquidity, institutional rails only. Retail doesn't set that price. Retail isn't even the target audience. And that's uncomfortable because it means most people are looking at XRP through the wrong lens. This isn't about when moon. This is about infrastructure. Now, here's where things really get interesting and where I want you to pay attention. If XRP becomes collateral for derivatives, it cannot be rehypothecated endlessly like fiat. It needs clarity, finality, settlement certainty. That alone favors a smaller supply in active circulation and a much higher unit price. Look, I know this sounds wild, but remember, the internet itself wasn't built for consumers first. It was built for governments and institutions. Retail came later. So if this is resonating so far, make sure you're subscribed, because the second half of this breakdown goes even deeper into how balance sheets, liquidity ratios, and institutional constraints force price outcomes that most people simply refuse to consider. And trust me, this is where the narrative flips completely. Institutions don't ask, what do we hope XRP will be worth? They ask, what does XRP need to be worth to safely support the system? That difference matters. Banks operate under capital requirements, liquidity coverage ratios, stress tests, collateral haircuts. Every asset on their balance sheet has a job. If XRP is used as a bridge asset in settlement, it must move massive value instantly without creating risk exposure. If it's used as collateral, it must hold value under extreme stress scenarios. That automatically disqualifies low-priced assets. Let's talk scale. If even 1% of global derivatives require XRP as collateral, we're talking tens of trillions in value support. Now divide that across a finite supply, not theoretical max supply, but usable liquid supply. You quickly arrive at five-figure valuations per token, not because anyone wants it, because the math demands it. This is why Dr. Jim Willie emphasizes that XRP wouldn't trade like Bitcoin. Bitcoin is a speculative store of value. XRP is a transactional instrument, two completely different roles. Bitcoin benefits from volatility. XRP at scale suffers from it. Volatility introduces risk. Risk increases capital requirements. Higher capital requirements make systems inefficient. Institutions eliminate inefficiency wherever possible. That's why a fixed or tightly managed price suddenly makes sense. And here's the part nobody wants to talk about. Retail price discovery becomes irrelevant once institutions dominate liquidity flows. Price stops being emotional, it becomes functional. Gold doesn't spike 300% in a week. It doesn't crash 80% on a rumor because gold is embedded in the system. Now imagine XRP embedded at that same level, but digitally native, instant, and programmable. This is where the IMF and BIS come into the conversation. Their job isn't to speculate. Their job is to maintain stability across borders, currencies, and systems. If a neutral bridge asset is required, they don't care if retail thinks the price is too high. They care whether it prevents collapse. Dr. Willie's argument suggests XRP could be assigned a valuation that makes it useful, not exciting, and that's the difference between assets built for traders and assets built for infrastructure. Let's address the elephant in the room. Would retail benefit from this? Early participants, yes. Late speculation, no. Once an asset becomes systemically important, upside volatility disappears, replaced by stability and yield-based utility. That's how every mature asset class evolves. Railroads, oil, gold, telecom, speculation fades, infrastructure remains. This is why so many people are emotionally attached to low prices. They believe cheap equals opportunity. But institutions think the opposite. Cheap equals unstable. Now combine this with tokenization. If trillions in real-world assets are tokenized, they need instant settlement without counterparty risk. That settlement layer cannot rely on dozens of volatile tokens. It needs one or two neutral instruments, and neutrality matters. No central bank wants another nation's currency controlling settlement. No bank wants exposure to another bank's balance sheet. That's why a non-sovereign digital asset becomes attractive, not because it's decentralized for ideology, but because it's neutral for accounting. This is the same logic behind SDRs. XRP fits that mold better than almost any digital asset. Now here's where the 12,000 figure becomes less shocking. At that price, XRP becomes efficient. A small number of tokens move massive value. Liquidity requirements drop. Settlement becomes cleaner. You don't need billions of tokens flying around every second. Efficiency is everything at scale, and this is why low-price XRP narratives break down under institutional scrutiny. The system doesn't need millions of retail traders, it needs reliability. So when Dr. Jim Willie says XRP may have a fixed price, he's not predicting a pump. He's describing an end state, a point where XRP stops being debated and starts being deployed. Now ask yourself one final question. If this thesis is even partially correct, do you think the system will announce it ahead of time? Or will it quietly build until the switch flips? History suggests the second. So whether you agree or disagree, one thing is clear. XRP is not being positioned like a typical crypto asset, and that alone should force people to reevaluate what price actually means in a system designed for settlement, not speculation. If this breakdown added value, make sure you're subscribed because this channel exists to explore the angles most people aren't even looking at yet. This isn't hype, it's architecture, and architecture always reveals the truth before the headlines do.